Hi, welcome to the Philadelphia Money Show. I'm John Dobis from Forbes. I'm joined by Wade Pfau, and he is from the American College of Financial Services.
That's right. Mm-hmm.
And you work with, what, financial advisors and other people like that who...
Yeah, we focus on providing education to financial advisors to help.
You're here to talk about what? Safety First Retirement Planning?
A new book coming out next week, Safety First Retirement Planning. It's one of the two broad approaches to retirement income strategies.
Those topics have been really in high circulation here at the show and other places because we're in a zero rate or negative interest rate world. So those old days when you could lock in 7 to 8% from a bond, mm-hmm.
which
could provide some nice retirement income. You're not going to get that today necessarily, not without taking some risk. So how do you look at the generation of income in retirement? How do you achieve it?
Right, it's a great question, and there's really three basic approaches, and you can start. The first is just with bonds, and we have this idea, there's this 4% rule of thumb about how much you can spend in retirement.
That's good, how does that work? If you're 65, and if you can spend down 4% of your portfolio every year, you have a very infinitesimal chance of outliving your...
That's the idea, that 4% of the retirement wealth in the first year of retirement.
In the first year.
Then if you get $1 million, $40,000, adjust that for inflation and your money should last for 30 years. But with bonds, you can't do that today. The TIPS, Treasury Inflation Protected Securities that we've had since 1997, you're looking at a 30-year real yield of about 0.5% right now.
Right.
You're looking at about a 3.5% withdrawal rate with bonds. So that is your first option to try to fund retirement with bonds. But if you want to spend more than that, to even have a shot at achieving the 4% rule, your options are an aggressive-based investment portfolio, maybe 50 to 75% stocks.
Yeah.
Mm-hmm. Or to look at also using the power of risk pooling through insurance and annuities as another way to spend more than bonds can support. That can also be competitive with the stock market.
So you mentioned investing in stocks. Is there any particular style or sector of stocks that is most appropriate? Like, do you need to buy dividend stocks because they pay you a dividend and you can spend that dividend? Or would it be just the same to buy a stock that doesn't pay a dividend but is a great growth stock, and whenever you need your money, slice off a piece of cheese from the block?
Yeah, so most of the research on retirement planning looks at long historical data sets going back to 1926 or so. And so usually focus on total returns portfolios. And whether to take a dividend-centric approach, it's controversial. There's not a lot of evidence on it because we don't have you need 30 years of data just to know how much you can spend, and we don't have great historical data on all that. But it seems to suggest that dividends can create new risks to have a dividend-centric portfolio, and so you may be better off with just an overall total returns.
I mean, money is the same no matter how you get it, I suppose. Mm-hmm. I think psychologically the idea, if your grandma, worked at Pfizer and you have a bunch of Pfizer stock and she said, don't ever sell it, and you wouldn't have to probably because the dividends would overwhelm you, and you can you can segregate in your mind anyway, hey, this is my spending money and that's the principle, but you'd have to invade principle, I guess, from time to time.
Yeah, the total returns approach allows you to invade principle, and I know a lot of people are not comfortable.
It sounds so evil, doesn't it? Like, I got busted for a second-degree count of invading principle in the state of Rhode Island. So, all right, so you've got stocks, but income-producing real estate assets. Is that something that's? I know that's maybe more of a specialty on the side. Those aren't financial assets, but that's part of it too, right? If you're
Yeah, it's an important question because a lot of the research just usually focuses on two asset classes, U.S. stocks and bonds. And so I did write an article in 2012 to provide a framework for how you can think about that and how you can build a more diversified portfolio, make your own assumptions in terms of what kind of returns and volatilities you'd be looking at, put that together, and then I provide a way to give you guidance on what's the sustainable spending level. And yeah, if you don't necessarily have to increase returns, of course that helps, but even just reducing portfolio volatility can go a long way towards allowing for a higher spending level.
It also keeps you less freaked out, which lets you stick with your plan.
And then the behavioral side of sticking to your guns and staying the course is very important.
Wade Pfau, American College of Financial Services.